Hi, my name is Alex, and this is Group Nine's walkthrough of Zipcar's financial model. So, diving into Zipcar's overall price structure and revenue streams, the revenue comes from a couple of different avenues, primarily annual subscription and membership fees, an hourly usage fee, and a mileage usage fee. So, a non refundable application fee is also used as a revenue stream, along with refundable security deposits. And we can see under revenues that Chase made an assumption of members taking 4 trips per month with an average of 4 hours per trip and 22 miles per trip. And these assumptions were used to project revenues for years 1 through 5, and an assumed attrition rate, which had been increased from earlier plan alongside target market assumptions in Boston, were used to project the number of members and associated revenue. So the first thing that we see under those member stats are the flat application fee at a rate of $25 per customer, and using those assumptions with 440 members that year gives us $11,000 in revenue in year one. That 440 member number is used because application fees are one time and tied to new members. Next, we have the annual fee, which is lowered from earlier plans to $75 per member. Here they are using the average number of members, 220, to arrive at 16,500. This is because the annual fees are recognized over time, so the model uses the average members to reflect partial year usage. Next, we have the per mile and per hour charge that were raised from earlier models. Both of these are usage-based revenue streams and also use the average number of members to account for usage occurring throughout the period. And then next, we have the security deposit income, which is included even though it is temporary, as it is cash that company is receiving, essentially free financing. And on that same note, the last line we see in revenues is the interest income on those security deposits. So here they're assuming a 4% return on the deposits, giving us the 2,640 in revenue we see for year one.
Hi, I'm Erin, and I'm going to be covering the cost section of this financial model. So, with most statements, you've got your costs separated by variable and fixed, and her fixed cost section has been split into the corporate level or overhead, where it doesn't matter the city or location, it should be consistent. And then she also has a section for just the Boston office for fixed cost. So, looking at her costs, we can see sort of overall that while the costs are increasing, this is at a decreasing rate that is sort of in relation to her projections of the number of members or cars she predicts over the years. And over here, I've sort of done the difference each year, and we can see that the number of members, which is up here, decreases over the years, including, I mean, in addition to the number of cars she plans on leasing to Zipcar over the years as well. And if we see here, I've sort of shown that her ratio she bases her whole model off of is about 18 members to one car, adding on each year. And this is shown throughout the model. We can see that the biggest jump is from year 1 to 2, where she expects 428 new members to 24 new cars. And that's why there is the largest jump in all of these costs between years 1 and 2. And then throughout the other years, as this stabilizes or decreases, you can see these are increasing at slower rates, and it's all scaled to that ratio of 18 new members to one new car. So going into the variable costs, the most expensive, or this is also done scaled to one car per year. Yeah. And we can see the most expensive are the lease costs, the fuel, and the insurance costs. And for insurance, I thought that was sort of interesting. I mean, we see it's still following that same pattern where there's a bit of a decrease each year. But it was interesting because in the text, it sort of mentioned that the companies that she was leasing from were wary about the credit risk involved in adding on new members each year. You know, you got one card, one person, not so bad, but the more you add on, the more risk there is. So I thought this might increase more. But again, she has scaled it with the assumption she will only be having that 18-to-1 ratio throughout. And yeah, so these are all you can see based off the car and variable. And these ones I would say have some of the most variability, the three most expensive, year to year. There's not too big of a difference in between. And then looking into the fixed costs, the most expensive are admin on both ends of the corporate overhead level, as well as the Boston office local admin level. And that includes, like rental space and salaries, utilities, maybe, whatnot. And some of the other most expensive points are billing, which is scaled by member, or that's the unit of measurement is by member per year. And then benefits, which are predicted to stay 20% each year. And we think this is where the mistake is, and another member will go into that more. But yes, those are the three most expensive for the fixed costs. But otherwise, you can see, I mean, clearly they're fixed costs. These are predicted each year to be sort of the same, whereas the ones that are based off a member, similar to the new car variable, that will change year to year, but not for the corporate level overhead. And down here, I've sort of done the total costs between the variable, the overhead to get that, and that would lead you to your net income before tax if you subtract that from the total revenue. So overall, I think this way of projecting is nice and simple, but that's part of the issue is that it's perhaps oversimplified based off this um, scalable assumption using just car or a member to do it by. And who's to say, I'm not sure where she got these numbers from, but I'm not sure why she'd predict they'd be decreasing each year. Maybe just, I don't know. Maybe again, this is probably just for Boston, so that's why the number of members, you kind of cap out based off the population. But it sort of ignores some realities such as economies of scale. Eventually, her tech costs, would be the same unless she wants to renovate. And again, on the opposite end of economies of scale are any changes to operation. She sort of assumed it would remain the same, and that's why it was so easy to predict year to year, is that we could base it simply off of a singular price based off that singular unit of car or member or even employee for benefits, maybe. But yeah, so again, like I said, it's easy to project your company Zipcar this way, but it might be an oversimplification of how things might actually turn out over the years. And that is the cost section.
All right. Next, I'd like to touch upon the profitability of the revised financial plan for Zipcar in Boston. The plan primarily focuses on the first 5 years of operation, showcasing the brunt of finances falling on the first years and continuing a stable revenue generation as time passes. Quickly viewing the profitability numbers of the years, they begin at 70,000 in year 1 before jumping to 500,000 in year 2. At year 3, it rises to 725,000, with the profitability still increasing each year, but the rate of growth dropping as the year 4 is 905,000 and year 5 being 1,055,000. So, why after the first year's jump does the rate of profitability taper off significantly? This can be primarily attributed to the revenue, with its initial jump also having the highest rate before reducing itself in the following years. With the new entrants into the market, one can anticipate that under this business model, most of the market in need of this product will join the Zipcar community within its first years of establishment. In these years, mostly year 1, year 2, and year 3, not only will the revenue growth be the highest attributed to that initial market entrance, but also the variable cost will match this as well. As the customer base increases, so will the variable cost. But as time passes, the Zipcar will not sustain the new customer growth rates as before, as the market of those who require a Zipcar becomes more limited. So, What this overall means for the company is that with its introduction, they anticipate to break into the market and generate its bulk of revenue within the first years of operation, and with those revenues, purchase the bulk of their various costs to match the demand. And as the market starts to become fulfilled and new customer rates decline, the current cars will allow to produce a stabilizing revenue as the need for additional variable cost growth rates decreases and fixed costs remain stable and similar throughout all years. So looking at the business model, the plan is to basically introduce the concept into a small area, create enough excitement and engagement to allow for the majority of the finances burnt to affect in the first years and then taper off as the market begins to be fulfilled. Sustainable profits continue occurring after the years following year 5 without too much additional increases in variable costs as the cars, parking, and members of the location begin to stabilize.
So to wrap things up, our team noticed a significant discrepancy in the Boston overhead section. Local administration is listed at 24,000 each year, but the benefit line marked at 20% jumps to 24,780 in years 2 through 5. If the benefits are really 20% of 24,000, they should be 4,800 per year, just like year 1. So what this means as an investor is that Zipcar's true profitability is actually understated in the plan. Even with this error, the business remains profitable. When we look at the big picture, this refined model works because it balances 3 distinct things. Number 1 being the low cost of capital via those refundable security deposits Alex mentioned, improved scalability through the 18:1 member to car ratio, and lastly, the market dominance as seen in the rapid year 2 growth. While we see the growth rate eventually tapers as Boston market reaches saturation, the steady state profitability we see in year 5 proves that the unit economics are still solid. The error we found only confirms that Zipcar isn't just a viable pilot program in Boston, it's a high margin, scalable blueprint that is ready for national expansion. Thank you for watching.